Hi, I'm Mike Ward. I want to show you the power of compound interest and some of the consequences of it. And I'm going to use an example, a real example, and I'm going to be using South African data because we have had high levels of inflation in this country for quite a while. So this is a picture of my first car. I got this Peugeot 404 for my 16th birthday present from my mother. And this particular car was in 1971, brand new, and it cost 2,706 Rand. I didn't get it in 1971. I was a bit young then. I got it secondhand a few years later. But just to give us a sense as well, petrol back then cost 11 cents per litre. Now, if we put this into Excel and just track a few numbers year by year, here's the cost back in 1971. I got the car actually somewhere here, and but still I've got the cost back here. So I'm going to just roll it back a few years. And let us assume that inflation for cars on average was 10.5%. Now it's been up and down, so I'm kind of making it simple here. But you can see that if I grow this by 10.5% every single year, and I go to the bottom, it comes to 360,000 odd Rand. Now you can buy quite a nice car for that now. And so that's kind of why I chose 10.5%, just to give me a number somewhere around there, because actually you could buy a better car, but that's simply because technology has also improved. I mean, cars come standard these days with electric windows and automatics and air cons and brakes and radio. I don't recall my car having many of those features. So that's what happens. Now, if my mother, instead of buying me that car, had put this money into the Johannesburg Stock Exchange, and I'm just assuming the all-share index over here, and that has given us, and I will show you that later, an average annual return, in fact, since 1960, of about 16%, slightly over 16% if you reinvest the dividends. And if we press recalc here, you're going to see that that now grows a lot faster. And if I go to the bottom, you will see that the value that would have been in the stock market had she put it there, instead of buying me the car, would be a 10 times more, nearly 4 million Rand. And you can buy a very nice car for that now. But, and kind of I start off thinking, well, maybe she should have just done that. Maybe I'd have been better off. But actually, you must remember that that car actually got me an education somewhere around here. And I'll tell you now, it got me a wife around then, because I think she was more keen on the car. So what I'm trying to say here is there are other benefits, to investment aside from just looking at the pure money. One's got to factor those things in. So, okay, so what about, though, if she had invested that money kind of with an asset manager? And so I have got money invested with Allan Gray, and Allan Gray is a big asset manager, one of the better ones. And he, in fact, started his fund in 1974. So it's quite nice because the data goes back more or less to the same time frame. I'm going to cheat a little bit here and just roll it back 3 years or so. Also, his fund, although you can see he's got data from 1974, that was a private fund then, actually went public 4 years later in 1978. And if you can read this, you can see that the annualized return that he's had out of his fund is 26.4%. Wow, that is pretty impressive. So I want to go back and put in 26.4% over here. So 26.4%, and press recalc just to refresh the numbers. And you can see this is now growing very much fast. And if I go to the bottom, you're going to be very impressed. This has now grown by, well, it's grown from about 4 million to 261 million. You don't need to do a t-test to see that there's a difference here. And wow, I mean, she should have done that. No question about that. But it's not quite that simple. So I want to copy this and just put it here, over here as a value, so it won't change. Just to remember the number. Because I didn't really show you everything just now. If I go back to this chart here, you can see, I don't know if you can read these words, but it says at the bottom here, these returns are before fees. So, okay, these are before fees. We must subtract the fees because obviously the asset manager keeps the fees. So if I go back to my data and I say, okay, what sort of fees would Allan Gray have taken off over that period? Well, Allan Gray have got they kind of have a performance-based fee. If they beat the index, which they mostly did, then they charge you more. Could have been 4%. And if they don't, which they hardly ever did, they drop it right down. So, and of course, these fee structures have changed over this time. So I'm just going to make up some numbers. So I'm going to say, let's assume, because Allan Gray mostly did beat the index over this time frame, that I need to subtract from here, I don't know, let's make it 3%. And I press F9, recalc again, now growing at 3% less. And that's a very big difference. You can see it's now 80 million instead of what it was. In fact, if we were to take what it was with fees, before fees, and subtract what it is after the fees, we can see here, this is the fees. So when you first do this, you sit there thinking, where's Allan? I want to find him. And well, one shouldn't get upset though, because actually he has still taken, or he would have. Remember, I got the car. So just to be clear here, this is a hypothetical example. He's improved the return here from 4 million to 80 million. I mean, you should be very happy with that. So I'm not suggesting you should be unhappy with the fees that your financial advisor charges you, but you ought to check it out, because if they cannot beat the index, then you should not pay any fees. And I'm going to tell you that these days, actually, it's very difficult to beat the index. And I doubt that they do beat the index. So you should check that out. And if they are able to beat the index, you shouldn't be too stressed. I mean, you'll complain about the fees, but you can't really say much. It takes a lot of skill to persistently beat the index. So I hope you found it interesting. And I hope you've got a sense of the fact that in high inflationary environments where interest rates are high, compounding is very important, and small differences in small numbers can make a big difference to the result. So thank you for watching.